to this event. We want to thank Anshan for the space, for providing this excellent space for us. And wanted to mention, I think most of you know about the forum. We do a lot of events in the technology entrepreneurship space. Some things we have coming up are one on April 16th, which I'm the co-organizer for, and I guess that's a sign of something, which is the future of music. Where is the money? And as part of our think tank series, which is sort of, we don't have any panel, we just have lots of lead participants, and we already have 15 to 20 lead participants, including somebody from Spotify, and a bunch of people with significant positions in the movie industry, I mean, music industry, and the manager for Amanda Palmer, and a lot of interesting people. There's a mistake in the program. The What's Up with Drones is actually going to be in the fall. So I think for this spring, the remaining event is June. There's a user experience event, which should have a very strong panel. And then in the fall, we'll have drones and an event on small sats, and we have a bunch of other things in the works. So with that, I'll turn it over to Mark Schneider, who will introduce you to tonight's event.
So thank you all for coming. Tonight we're going to talk about financing tech companies at various stages and get the perspective of investors, bankers, and an entrepreneur who's actually done it right. So the format, I'll give everybody a chance to introduce themselves, and then I've got some preceded questions that we filtered around, and then we'll leave plenty of time for questions from the audience. So Ben, why don't you start?
Thanks, Mark.
Introduce yourself. And
yeah, I'm Ben Boissavain. I'm managing partner with Wall Capital, and we focus on merger and acquisitions advisory in the tech sector. 3 partners, one's from Bell Labs, Alcatel-Lucent. The other one's from Ericsson, Qualcomm, and SoftBank. So really heavy tech knowledge and very international focus of the firm. Got clients in Spain, South Africa, India. We also do domestic transactions as well.
Sure, I'm Alex Goldberg. I'm part of Canary Ventures. It's a small micro VC fund. My background, just to relate it back to the Enterprise Forum, I've worked for 4 venture-backed startups in Boston and Cambridge. 3 of them came out of MIT research. As an operator, I was very much in product management, the alignment of business and technology, particularly around infrastructure software, certain types of other technologies, B2B software as well. And I currently have probably about 12 to 15 investments in this space. I'm very active with New York Angels as well, which is how I know a few of the characters up here. We'll get into that later.
I'm going to follow you. Okay. Wow. Jeffrey Silverman, Managing Director of Laconia Capital Group. 25 years in media and technology, and after stepping down from my last company about 5 years ago, started doing some angel investing. That evolved into starting a small micro VC fund. We've just started, we just about to close on our second fund. Our first fund has about 18 companies. That was mostly seed to pre-A focused. This one is also in the same, but a little bit later, probably pre-A to A focused. And we're do B2B.
Hi, I'm John Shaw. I'm with Nimbo. I'm the CEO of Nimbo. We are a multi-cloud company based in New York. We've got offices in Houston and San Francisco and Seattle. We were recently acquired by Equinix. What, not Equinox, the gym, whatever he thinks it is. It's actually a $12 billion public company, one of the leaders in data centers worldwide. I guess I'm here to do it right. I don't know how right I've done it, but so we made the exit 2 months ago, so I can share some stories on that.
And I was remiss, I didn't introduce myself. My name is Mark Schneider. Sort of about 3 years after MIT and a couple of years in the corporate world, I got into the software industry, and I guess I used to say I had a 10-year business plan, and like all software projects, it was about 2.5 times longer than the original estimate. But sometime around 2000, I went from running a company to being a full-time angel, and which is where I met some of these guys, New York Angels and Angel Investor Forum in Connecticut. And so we put this together today to really get different perspectives. At the earliest stage, entrepreneurs have some needs, and angels have different expectations. As you travel up, VCs and funds have different perspectives on things, and of course all of that revolves on what the entrepreneur did. And then ultimately, how does everybody exit? How does everybody get their value? And we looked at folks like Ben. So, so with that, why don't we start with, and I guess I'll ask questions, and anybody that wants to jump in, take the first, and then if everybody else can comment on it. So one question was, so once you've met with a company and were impressed by it and started down a diligence path, what are some of the frequent reasons you might walk away from a deal?
Go first.
I'll go first. Very simplest level, basically a VC or an angel or a seed funder is interested in two things. Is there a market that's going to exist? And that requires some expert knowledge of a particular space. And different people come in with different biases, different knowledge of an industry. And secondly, we look to see whether a team can actually execute in that market. Do they have the different skill sets required to be successful to capture some significant market share? And again, when we come from this as inventors, as software technologists, as academic researchers, sometimes we're coming from a slightly different perspective. We think, oh my God, I invented this really cool thing. I bet someone would want to buy it. And so from a purely investor or VC perspective, we kind of use these two filters. Again, what's the market and can the team execute from a commercialization perspective? I run into some people with very different understanding of what the value of their company is at some moment in time, and maybe Jeff can talk about some of his stories there. I run into some people who think to themselves, I have this early stage startup and I really want to engage an investment banker maybe a little too early to place just that first couple $100,000 to get that money running. And sometimes the financial models that our good friends, the investment bankers, put together for the early seed phase companies just don't quite match what the VC investors like to see. And and then just to throw it out there, there's a lot of human element to this as well. I like working with people who are coachable. They're kind of fun. You hang out with them. They'll push back. They're stubborn but coachable is what I say. They'll listen to some advice, and you can kind of feel like I'm going to whisper in the horse's ear as it's running around the horse track, and maybe nudge it over 10 to 15 degrees to the left or the right. And if I don't sense that we have a nice rapport, even if it looks great from all the other check boxes, I can't really engage personally because I know I need to have that to get going.
Yeah, I would concur. The two things that are key during the process is people and can they execute. You can have the greatest business idea, but if you can't execute, it's not going to be worth anything. So during the due diligence process, we'll walk away at a point that we've lost, that we don't feel that's the right team, or they don't have the ability to execute, or the market is just, it doesn't meet our filters that we require when we're looking at companies. So it could be we can't have an ownership stake large enough to make it worth our while. It might be too capital intensive of a company that they're going to need $100, $200 million to get this, and we play in a very early area. So by the time our 3 to 5% is going to be whittled down to 0.001. It's not worth that. So we balance all of that. But at the end of the day, it's the team, and do we believe that the team can execute?
Yeah, we actually had like maybe 3 or 4 offers during the period of NIMBO, and we declined all of them. And we didn't get to the LOI. So the LOI is the letter of intent. Once you get to that stage, really, you'll upset if you don't at least go forward with the due diligence. But we felt that the company had more runway, and we could grow it larger. So we didn't go forward except for the Equinix opportunity, because frankly, people buy from people. So to the point there. So if you can't work with these people, I'm on a 2-year earn-out, right? So it's a different perspective in these guys. So if you can't work with the people who are going to buy you for 2 years, it doesn't matter how much money they give you, it's not worth it. Like time, you can't get back. So the company was really, really nice. Steve Smith, who's the CEO of Equinix, I could walk in and like shake his hand. He said, he owns the company. And it's that kind of culture that you need. So if there's a culture fit, and you can work with these people and you see that there's a fit, but on the other side of the transaction, just selling the company or taking money, if you can work with these guys, it'll make your life a lot easier. If you can't, then the money doesn't mean anything.
Yeah, I'll give you just 2 examples. So we do merger and acquisitions advisory. We advise companies on buying companies and also in selling. So I'll give an example of each. We were on a buy side for a very large Indian software and services company, and it was a $330 million transaction. Great company, healthcare sector, like growing, great management team, everything was perfect. And there's always something in the due diligence process, right? It's always fascinating. There's always some skeleton in the closet. Well, this was a closet. The IT director for the huge Indian company came back and goes, their whole servers are all in a broom closet, literally. That was it. That's all they had. So the deal still went through, right? But there's always weaknesses. And the key is when you're preparing to sell your company is to really look at your accounting, look at your IT, look at your management team, your sales process. There's a good chance to actually plug some holes before you go to market. That's my one piece of advice there.
I want to just fill up one thing Ben said. It's very funny. The scariest meeting you have, or we have with our entrepreneurs, is the one after the check is clear.
Exactly.
Because you can do diligence all you want,
Yeah.
but you can answer the question. You can tap dance. I will walk in, usually 30 days after we close, we sit across the table from them, we said, okay, we're partners. The check's cleared, documents have signed. So what questions didn't I ask?
Right. What did I miss?
Or what questions did I ask that you really avoided the answer? And like, just tell me, we're partners. Let's get it out. And you hear this, well. So that is the scariest meeting.
They should have told you.
No one asked about this.
Yeah. Well, I had to give you one more example on the sell side. So deals can look really sexy and appealing on the outside, and then you sign the engagement letter in our case and represent it, right? So it's a $1 billion public company, it's mobile analytics, their sales are going from 4 to 6 million, everything's great. So we sign the engagement letter, we get the financials finally, and they're losing 10. They're losing 10 on 4. On 4 million of revenue. I don't know how they do that, but
The hockey sticks like this.
It's called a division of a public company. So you actually got that deal done too, but you always see something.
Okay, so a couple of you mentioned team and people. At every stage, whether it's you're raising your first dollar or you're exiting and selling, team. We all hear that team is important. We all know that team is important. But how does that affect, and what do companies need when they're raising that first round, that second round, exiting, and all of a sudden when you're exiting, I'm sure you've had people disappear the week before the close, key people or almost key people or scary people. Can you tell us about team in each of your areas?
Yeah, so I'll go first, and then we'll go with Alex. You want someone, the person you're investing in this early stage in the person, in that team or that 1 or 2 people. And it's trying to find out what works. And what we have found for us, and there's exceptions to every rule, is we want someone who's a sales and marketing type person on the team. You can build the greatest technology in the world, but if you can't sell it, then it's not going to do anything. It's going to sit in the shelf or sit in the server room. So when we're looking at things, we really want to see that team have somebody who really has that sales and marketing expertise, and has also on the team that operation type experience. The developer is important, the product manager is very important, but from the first 2 core for us, those 2 are the key positions for us.
Yeah, I think of it as like a timeline. Think of milestones along the way. So at the seed moment, I'm sort of assuming that there's a hustler, kind of like what Jeff just mentioned, and then there's someone who can execute and build something, a real technologist and a leader, particularly in this sort of B2B or infrastructure or technology invention space. As things progress, my hope is that at the moment when I'm getting engaged and more broadly, sort of as you get closer and closer to Series A, there's an expansion both of your sales and of the team requirements. So if you imagine that the moment when a Series A is really going to happen, what's happened by then? There's a customer or 2, there are a couple additional customers, you're beginning to refine your product market fit, You begin to understand what's the repeatability of your solution. You can build one, you can build two, but could you get to 10 or $20 million? Could you begin to build a financial model that represents a real ramp? And that's the moment when sort of that just before Series A or the Series A investors get sort of very excited. They want to put money into a situation where for every dollar that we give you, you can show that you're going to get $4 to $5 in revenue or whatever the ratio might be. And so when I think about team from that vantage, as you scale from the product market fit to the 3 to 4 to 5 sales that show some confirmation that you have a real invention that has market validation, and you move on to that moment where you can scale it, you're going to have to show additional skill sets from customer management, et cetera. We find that having a very strong advisory board to fill in your missing pieces is really important. So I like to judge the investor, as an investor, I like to judge the entrepreneur, not only who they have, but who they envision they're going to need to hit that hockey stick, and that they have some tools that are inside the tent that can help them identify those talents. In certain cases, I even have individuals who say, I have this guy or woman who's committed. As soon as I get X million dollars, this person's sworn to me that they're going to leave their job and join me, and they have this following set of connections. So, I mean, if that makes any sense. You can actually solve a lot of these problems ahead of time, and it helps pave the way to a faster investment process.
Yeah, so for mergers and acquisitions, it's a really critical component, and it depends a lot on the deal. So I'll give you two examples. One is we have a $1 billion Spanish company client that's buying a software company in the US, and they're headquartered in Madrid. So they want to make sure the team stays, right? Because the worst case scenario for them is they cut them a check, $5 million each or whatever it is, the team members, and they all go off to the island, right? It's called island money. And it happens. I've seen it. People get $5 million. They think they're committed, but they're not committed. They get the check, they're happy, but all of a sudden they have to report to somebody, John, and have to get their numbers done. It's like, a boss? What's that? So they just leave the scene. So it's really how you structure the deal about, it's typically an earn out with management bonus along the way to make sure they don't get all their consideration up front. They've got a carrot at the end of a typically 2 to 3 year period.
Yeah. Well, I'm going Napa next week with my boss.
Oh, that's good.
So
That's a great relationship. No, it worked out great. That
Well,
goes,
boss and other people, and my boss.
but John, that goes to you too. What you
Yeah.
were saying before is that when you pick, you want to make sure you get along on a personal
Yeah.
basis. It's important. You're working together.
Oh, it's really important. I think, it depends on what level you are. So if you're a startup versus you've got a business that's ramping. So startup level, I think you need somebody who's gone to business school, frankly. I didn't go to business school, my wife did. So she went to London Business School, so she actually knew somebody who was a rock star. And he did M&A transactions, and he went to business school and was like, I want to do startups. And really that person helped us to get the line of credit, helped us negotiate the deal. Because the worst thing you can do actually is to have you as the business owner negotiate the deal. Because there's two problems with that. One of them is, if you're negotiating the deal, you haven't got any leverage. The second is, if you negotiate the deal, you're taking your eye off the business, and you can't run the business. So having somebody else who's an operational person, I suggest in business school or Columbia or one of these others, just somebody who's done it before can really help your business. And an advisory board, you can give them a couple of points, not a point or whatever. Sometimes they're happy to do it, and there's a lot of people who don't be afraid of asking for help. I think that there's a lot of people will help you in your business, but that is key. An accountant's really key. I was talking to a guy tonight about accountancy and all that distraction. But you have to understand it as a startup. You have to understand how many days you've got until you go out of business, and learn those really lessons that if you don't learn those lessons, you're going for money and understand how your business is working. Don't get somebody in like a CFO from day one if you're a startup, because you're not going to learn the business. Ask for money and say, well, the reason why I need this is because of this reason, and they'll go, okay. He actually understands the reason why. So, it all depends on the team and where you are in the cycle. But
So just continuing on this theme, at the earliest stages, when do you, and to keep it simple, let's assume you're a sole entrepreneur. How do you deal with that first hire and equity, and that first important key hire, and equity, both from his perspective of the investors, what are they looking for? What would we investors recommend to that entrepreneur who currently owns 100%, and how we should attract the base level team that he's starting with?
There's a book, Harvard Business School professor Noam Wasserman, I believe, The Entrepreneur's Dilemma, and he specifically spends 400 pages on this question. Basically, it has to do with vesting. The worst thing you could do, I can name a couple companies, I probably shouldn't say their names, but where a founder came in, brought a co-founder in, that co-founder owned 50% of the work of the company, and then they just didn't show up to work for the next 4 years, and then the company had a huge exit, and the first founder regretted it for the rest of their lives, and they will at least. And so to the extent you can create these structured vesting schedules based on milestones, time, et cetera, there's some really interesting, pretty simple Excel spreadsheets that all of us are capable of putting together, where you say, you know, if you complete this by this time, then you get this accelerated vesting. If you're here until this date, you get this accelerated vesting. And in effect, because you're part founder, you get this amount. Because you've been here this long, you get this amount. And because through some sort of dynamic process, you can arrive at what you all agree ahead of time is fair. And you'll incentivize yourself to be there as well. The person who comes in, who puts all the sweat equity in, doesn't want you to disappear either. So I think my suggestion is read that book.
I think hiring is the most important thing. You know, you'll see people just make a quick hire because they need something, they're desperate. Good entrepreneurs, good executives are constantly interviewing people. You know, they're constantly meeting people, going out to lunch, breakfast, just constantly keeping it going as who's out there. Because when they need that, they want to find the right person. And on the reverse side of that, the other side of the coin is when you've hired, you've made a mistake, act on it quickly. So we met with one of our companies a couple weeks ago, and I said, you know, so what's up? Let's go over the update. And they said, we fired our vice president. He was in the job 60 days. And I said, good for you. And he looks at me, he's like all surprised. I said, tell me why. He's like, well, this wasn't working, he wasn't doing that. And I said, he goes, why'd you say good for you? I said, because you didn't sit and wait 9 to 12 months. You really wasn't a fit. You cut your losses and you're moving on. So hiring can really affect growth, it can affect culture, and then how you compensate them, like, agree with Alex, it's, you know, you bring them in and it's a vesting period.
Yeah, just one other addition, Richard, is that the cap table is really important, you know, the shareholder percentages, options, stock options, and so you fire the VP, or your example, Alex, like 50-50, it's like, they can block a sale, potentially.
Oh, yeah.
That's
Yeah.
the problem. And we just had a situation like that, got cleaned up, so 10% co-owner only had 10%, but you could still muck up the work for 6 months. It's still going to go through, but you got to review your cap table like at least once a year and make sure it's clean. You know, if there's
That's
a
a
problem,
key
address it.
skeleton in the closet. that
Absolutely.
exists.
Yeah, just address the problem.
And making it
Find out.
attractive for the next round.
Absolutely.
A firm come in at a later round and look at this and say, this is just an ugly cap table. This is not, the company might be attractive, but this is just going to take a lot of heavy lifting to make this, clean this up.
I just saw a cap table with 50%, 50% CEO, CFO. I was very happy. That's a beautiful cap
That's
table.
really, that's good.
So simple.
Yeah, I think set up an option pool will incentivize hires. My opinion, in equity terms, in regards to the book, it's either money or IP. If the IP is like strong IP, you give them more equity. Developers, though, they always seem to think that they've got more IP or more equity that they need. So with a developer's like saying, I need 50% of the company for me to do this, you have to understand, like, okay, well, I have to do sales, operations, I have to do all these other things, and that's the reason why maybe 50 isn't a good number. But a vesting schedule would work. When we got bought, what we did is actually clean that cap table out, and I personally made a decision not to pay those out because I didn't want to have the rest of the option holders to have the same burden that I had, right? So they got full payout. I'm on an earn out, which is different. So the reason really is because you have to include them into decisions, right, going forward. So the earn out, what are we, and all that. It's simpler if you've got a few people that you can, the company's going to buy you, put you on the hook for. You don't like a team of, like, you know, a camel, was it the a horse is accountable by committee, right? So that's a situation the investors don't want, or the companies don't want. They want a few people that can really hold accountable. And options, by the way, be very careful, right? So when you write options, get a lawyer to review them, because it really upset a few of our option holders, because it's hit. Some options are determined as not capital gains, the ordinary income, and that really upsets people very much. So luckily, there was a retention bonus that the company bought us gave us. So again, if they're part of the equation, don't be afraid to ask the company to say, hey, you're buying us, but why don't you help us fund some kind of bonus pool to keep these guys around for longer? And they did. So be careful with, options are great. It does incentivize people, but if you're going to sell the company, they're going to be faced with big taxes, especially in New York.
Okay, so
I live in Texas, by the way.
So we're gonna move over to get, the next section we wanted to cover was there are a lot of technology companies that come out of academic research, and what are the few things that entrepreneurs should keep in mind when they're taking academic research and trying to build a company out of it?
I sort of distill it down to 3 words. It's ask the customer, which is a very counterintuitive thing to do, but I highly encourage it. I think every founder needs to constantly talk to who you think you're going to sell something to. I've talked to some incredible research departments that design incredible inventions that in one context, in an academic publication or a symposium context, they're heroes. But when we as investors look at things, what we care most about is market testing, product market fit. So I'd say really start with asking as many possible people, what on earth do you think of this? Would you buy it? Who within your organization would buy it? How do you ascribe value to it? I almost view it like being a detective. I come from sort of a product management school of thought where I build interview guides, and I literally want to just worm my way into their organization, understand who the influencers are for the purchasing of the technology, et cetera. So there's some models that people have used in taking academic research and commercializing it and then figuring out how to sell it. But to the extent you can test it's the purchasing power someone feels or the selling power you have, et cetera, that's really the key.
MVP is the key, right? You take an academic research, do an MVP, minimum viable product, getting into customers' hands and iterate. If it's not a fit, get the customer to try it out and see. It's actually there's a recent came up. There was these guys that were doing a bass speaker and was putting out fires. I don't know if you've seen this. It's like
Saw that, yeah.
yeah, it's awesome. So I was thinking with our company, maybe we can get some drones, right? So get some drones, put this speaker thing and puts out fires, forest fires, and maybe we could do swarm and all that. And my co-founder was like, can you just stop and just focus on it? So that's half the problem is that, right? So, but yeah, I think minimal viable product, definitely find a customer. If you can't find customers, what's the point, right? So.
The other thing is, I think one of our friends is an adjunct professor at the Fashion Institute, and they've got some great ideas about fashion businesses. What they've done is developed a partnership with NYU Business School, and so these entrepreneurs who might have creative and some really great visionary ideas partner up with someone who understands the business aspect of the business, and I think that's important too. Find someone, you mentioned it earlier with your wife's contacts.
Yeah. Find
Someone who knows the business. Great idea, great technology, but what are the metrics to going into helping to build that?
Okay, so moving now to the financing area. So over the past couple of years, VCs seem to be pulling back from the earliest seed investing and focusing more on what we now call A rounds. And the A rounds are coming with higher expectations, larger fundraisers. Can you comment on this changing landscape over the last 2 or 3 years?
Yeah, so it's interesting. I started getting into this there was, the angels could play the 0 to 10 million. That was where the angels, the VCs never came back down there. And then companies, venture funds like First Round, Lear Ventures and others started to come right down and start to write $50,000, $100,000 checks. And really became very competitive, good for the entrepreneur between that. In the last, I'd say 12 months, you've seen a number of the funds pull back and start to move back up the chain a little bit. And what that means is when you start to go out, we're actually having companies, when companies are going out for raises, we're making sure they use the right wording. So just because you've raised a round, doesn't mean you're going back out and say, well, now I've raised one round, that was a seed, I'm now going to raise an A. Because the expectations on what A-round investors want to see, the bar has been raised very, very high. So 2 or 3 years ago, seed was an idea on a paper, A might have been few early adopters of customers, still getting there. The expectation for an A now is you're applying money that's going to accelerate the growth. That you understand the product, you understand the market, you understand how you do pricing, and you might be either penetrating that market segment or expanding it. But there's not a lot of testing going on, at least from what I'm seeing.
Yeah, no, I think what we're seeing right now, I'll answer it 2 different ways. One is to say that, I think a lot of the VCs that are thinking about Series A, generally speaking, as a rule of thumb, at least they say they want to see $1 million in revenue. Some sort of a repeat, is that higher than you see?
Yeah, I think it's higher now.
All right, it's higher now. Yeah. So I mean, you talk to Braycroft, they don't want to talk to you unless it's at least that much.
Right, no, right.
So that's one answer. The other way I was going to answer the question, though, was essentially the DNA of different startups, in my view, lead to a couple different results. What people are talking about a lot now is so-called unicorn hunting, which is looking for companies that someone believes is going to be worth over $1 billion someday. There are other companies, which are equally valid companies to start and to fund and to be participants in, that are what we sort of call early exits or product line extensions. There's nothing wrong with either one of them, but it's key to understand from the outset which of the two companies you are. And there are a lot of different ways we can help tell what they are. But to the extent that you're a potential unicorn, your proof is going to have to show some amount of traction, and you're going to have to show some evidence that the market size of what you're penetrating is quite massive. To the extent that you're a product line extension, and perhaps what we might think of as a quick flip, or a 3 to 4 to 5 year sort of quick, well-planned exit with 3 to 5 well-defined acquirers, you're going to use a slightly different playbook, and your financing strategy and the evidence you need to show is going to be a little different.
Yeah, I'll give you 2 perspectives of what we're seeing. So I think there's a bit of a bubble now at 2 different ends in the market. One end is the unicorn market, where you get billion-dollar companies, they're all staying private. They're not going public because the valuations, they get a public valuation. So if you're a late-stage VC, Clyde Perkins, and you can sell stock in a unicorn to the institutional investors who are all getting in now, like Fidelity, why not? You can sell it for a higher amount. But what does Fidelity do with it, right? If you go public, the valuation is probably going to be lower than the private valuation. So the problem is, it's a greater fool theory. So who does Fidelity sell to? It's a game of musical chairs. We've seen that once before, I think in the dot-com era. The other thing we're seeing is a lot of companies try to raise a B round, right, or a C round, and their existing investors do not want to re-up. Bad sign, right? Really hard to raise capital if your existing investors don't want to put money behind you. So we're getting those calls already. We got one call the other week. It's like, we have 3 months runway in cash. It's just unrealistic. So I really predict towards the end of this year, there's going to be a lot more of those calls coming. There's a lot of money chasing very few ideas. I don't know what you guys think of the bubble theory, but that's my own.
You had a much better bubble answer earlier than I did, so I'm not even going to stress that.
So I personally do think there's a bit of a bubble going on in a couple different areas, but I also think it's not as important to me personally from I guess, an Alex-centric view of the world. In effect, if you believe that there's a really big bubble going on, then you need to worry that at some moment in time in the next 1, 2, 3 years, whatever the timing is, there's going to be compression in valuations, and the number of exits that are possible at the very high end are going to reduce significantly. And so what that indicates to me is that I should avoid investing in companies with too high of a valuation at this moment in time. So personally focused a little more on a playbook that's not unicorn hunting. I'm kind of interested in a more tactical type of investment that does not presuppose that some highly inflated sort of market cap is going to be my rescuer in some number of years from now.
And Facebook and Google can only buy so many people.
Yeah, absolutely, yeah.
I really have an opinion on that.
So at the earlier end, angels, many angels drop out after several years when they realize this is a longer haul than they realize. And companies raise money at potentially too high valuations early on. And then they find that whereas they thought that lots of VCs took their calls and said, yes, come back to us when you've gotten to this stage or that stage, they find that they need multiple rounds before they get to this stage or that stage. Could you comment on how too high of an evaluation sets them up for challenges?
Yeah, people look at valuation, especially early, as a badge of honor. I got 5 million pre. You're just going to make your life more difficult later on. As long as you have the equity protection that you've got, your cap table's good, you've got a nice percentage of ownership, you want to make the business set up for success, not only from an execution side, but from a financing side. I know when a lot of people come to us and they say, we're going to raise, pre-money is 4 million, we're going to raise $1 million, our first response question is, okay, what milestones are you going to reach with the $1 million? What do you mean? What are you going to accomplish? And is those milestones going to secure a next round funding? Because what really happens a lot of times is they have a number in their head. They get the money, they go to execute, and then they go out to raise money from raise additional funds. And they realize that the metrics they have aren't enough to secure the next round. So what do they have to do? They have to either go back to the insiders, raise additional money, they have to come up with a note, and they start to scramble, and they put themselves in an uncomfortable situation. So one is, do an evaluation that makes sense, and two, make sure you're raising the right money to reach the necessary milestones to make the next raise easier. And you have that by having conversations earlier on with those next fundraisers, those next VCs, to say, what metrics are important to you? What levels would you want to see? And then that also drives development.
Yeah, we've got a client that right now that is in Europe, and they have 3 offers on the table. So we've done a really thorough marketing process from the M&A side, but their valuation was too high initially, right? They were sky high. They're like, we're 20 million. They're actually worth about 10, right? So the problem there is, talk about compression. Then you go back to the cap table. Okay, so you're preferred, you're common, you're A, you're seed. Everybody's going to take a haircut, but then they all get out their calculator and try to figure out, start fighting amongst each other for the little scraps. So it can really set you up for failure on the M&A front too.
Yeah, I've never taken any money, sorry. But I'm from the old school maybe of just making revenue,
Right.
And that's the thing that is most important. But there is a point, and we definitely felt it last year. If you want to take a company from a certain number, say 10, to say 30, that's when you need money for what we do anyway. Taking a company from 0 to $1 million should be easier. Then, so there's stages that in a company's life cycle you need money, and there's dumb money and smart money. Don't ask for too much, you'll end up buying slides in your office and ping pong tables and all that, but you should use it for the right thing. Getting some really good hires, getting the right people in, really helps, I think, to define a strategy. So, yeah, I think in terms of the money side of it, we've never taken rounds, but so it's kind of the A, B, C, D. Maybe if I have to do like a product, I'd come to you and ask for some money.
No, I was just thinking about it. Like, I've seen situations where someone says, I got a term sheet, it's what I believe 50 to 100% too high, and I just want to fill it out. And I say to them, listen, I have to walk in these situations. It's kind of sad, but, just to let you know, I think you're really interesting. We have a great rapport. You have an interesting company, but to be honest, I appreciate that you found some people and you told them this number and you agreed to it, but you're gonna have to fill it out, and maybe you will, but there's just no margin for error, even if you do. So my suggestion is that you right-size it to a reasonable number, and you know, it's negotiation, and you can talk to people you consider your trusted friends and advisors, but we always try to encourage people to you know, just keep your number down on earth, because you want to have as big of a consideration set as possible when you consider investors.
So I'd like to dig down a little bit further on that, the quantity of the raise, the dollar amount of the raise, and whether entrepreneurs should focus on a set number of months or a particular milestone that would achieve something for the investors. Can you comment on just how much a company should raise?
Okay.
Yeah, I mean, depends the phase that you're at.
Let's talk about first round of non-friends and family money.
I think we're typically seeing people raise between, call it, at the lowest end, 500K up to 1.25 at the first non-friends and family. You know, the friends, family, and fools, the 3 Fs is initially. And as you move outward to the you know, quasi-professional angel and seed investors and whatnot, that's where you're actually sort of showing people some amount of market-tested evidence, and you know, I think that's where you really want to accomplish the product market fit and some degree of scalability evidence. And as we talked about earlier, there's a moment when you hit the Series A where you're trying to scale up at a much more you know, enterprise class amount.
And how long should they plan on that money lasting?
I think it's, which money, the second money or the
No, that first round. At 500, you put up 500 number.
If you want to look at,
And for some companies, it might be 3, it might be a million. but
Okay,
how long should
it's
it
gonna
last?
take 3 to 5 months to raise money. So I want the team to execute, and I want to focus on execute. So I would like to see 12 to 16 months of money, because it gives them time to really get in there. You know, we do not do rolling closes. So, you know, rolling closes, someone says, oh, I'm raising $1 million, I've already got $700,000 in the bank, and they spend the next 3 months trying to execute and continue to raise money, and that's not, you know, they're just constantly trying to do, it's a full-time job to raise money. And so I'm looking for them to raise enough to hit the milestones they need to ensure as best as they can in the next round, but they're gonna need at least, you know, 12 to 16 months, because your last 3, that means 9 to 12 months you've got.
Right, you're raising the next round.
Yeah, you're raising your
Yeah,
next 9
exactly.
months, so
Yeah.
you're done, and it's like,
Yeah.
okay, you're back out on the road again.
Yeah, exactly. So what we see is a lot of companies don't have a good idea of the use of funds, whether it's 500,000 or, you know, 20 million. We're doing a 20 million private equity raise right now for a really interesting social media company. CEO's brilliant, got on the phone, it's like, okay, use of funds. I'm not really sure. You know, is it for marketing? Is it for developing the product? Is it expanding the team? You got to really delineate per dollar what you're using the money for. It gives them a lot more confidence, investors. And the other word of the wise is that, you know, you really got to target your investors. So I'll just give you one example. I had the same CEO, and he learned from this mistake, but he goes, oh, you know, how much they're raising? He's talking a very large private equity fund, and they like to deploy a lot of capital. Otherwise, it's not worth it for them. You know, if they invest $1, the ROI is going to be horrible, right? If they invest,
Same amount of work.
yeah, exactly. If they invest 30 million, it's definitely worth it for them. So he goes, oh, we only need 10 million, we're very lean, which sounds like a great answer, but it's not, because these guys want to deploy 30. So you got to match your investors, and the same thing in the early stage. You don't want to go to a late stage fund. You want to go to an early stage fund. Is that about right?
We've actually got, it's funny, we've got a competitor, so we're one of the leading Amazon partners in the States, one of 30. And one of our main competitors, I keep our eye on this company, and 2 years ago they raised $20 million. And I was like, wonder what they're going to do with that money. And within 12 months, the CEO got fired or put in another departure allowance. And they raised another 10. And I actually met up with the CEO of this company because we were all in the same, you know, group. And I said, what happened? You know, why did you know? And this guy was like a institutional CEO. He was very like the VCs must have brought him in just to like get this back on track. What's going on? And it's all about taking the right money at the right time, because they were very similar to us. and we didn't go down that route because we didn't think we needed it. And it's taking the right amount of money, and because if you don't, and also understanding your strengths and weaknesses. So again, going back to the phase of when you take the money, and swallowing your pride and saying, okay, if I'm the CEO or I'm the COO, whatever it is, can I be that same person in the next phase of the company? Can I really build this company, or do I need help? And the best people, entrepreneurs I've seen, is people who step back at the right time and or step sideways. And if you do that, I think investors, I don't know, they'll appreciate that, because okay, we've got a problem here. But instead of like coaching the horse, I would say coaching the dead horse around the track. Sometimes you are, right? So it's kind of like making the right moves and pivoting, because it's all about the business. So.
Right.
So when should a company consider selling?
Well, there's a few signs you can look at. So number one is you got to look at some sense of the market timing. It's very hard to predict, but if you sold in 3 years ago, you're dead of the nuclear winters. It's 2012. It's like nothing's moving. Valuations are low. Probably a bad time to sell, right? Unless you really need to. Now, I'm seeing signs of a bubble. Could be another 2-3 years. Could be tomorrow, right? When the music stops, Uber stock drops, et cetera, et cetera. So you gotta have some sense of market timing. It's not your number one priority. Number two, your number one priority really should be look very closely at your competitors. You usually have like 5 competitors around. And as you were saying, deals take 6 months, right? So if your number one competitor just got sold to Google, there's 5 other deals in the works, right, that are taking 6 months to complete, and all of a sudden, your 5 competitors are all sold, you're the last one. You just have 5 fewer buyers to sell to. They've already got it. They've already got your particular product set, so they don't need you. So what happens is supply and demand. That's the M&A market. Like every other market, supply and demand. If you're the last guy to sell, your valuation is going to be much lower. So that's one indicator as well. And sometimes people get approached, and that's it's good to consider that. You don't want to sell too early or too late, but you should always get competition in the sales process too. That's the recommendation.
I would also say when the entrepreneurs, they've hit their limitation. They've exceeded their thing. I've got not an investment, but 2 friends of mine who have built a company. It's going to do $2.5-3 million this year. It's profitable. They have got 14 employees. They know what they're good at. They're selling. They've just said, we've built this.
Yeah.
They feel, we could definitely continue to build it and they've never raised a dime, but they feel at their place that we have done what we can do. This is what we're good at, and now's the time for us to get out. And
Smart.
I really got a lot of respect for them. And they'll sell the company. They'll probably sell for north of $30-40 million, and
Yeah.
they're done.
Exactly.
And then they'll go on to the next thing. But they know themselves. They know what they're good at.
I actually encourage entrepreneurs to, at some point, particularly after the financing, during the board meetings, at least spend 10 seconds just to review who the potential acquirers might be. It may be way in advance of any transaction, but at least in the companies that I get involved with, there's usually a pretty well identified set of companies that you may eventually want to either talk to or potentially even develop channel partnerships with, begin to have relationships, etc. In terms of the timing and sort of how to sense that, I sort of notice about 2 or 3 phases. I mean, usually at the very beginning of these market adoption curves, you'll see 1 or 2 companies in a space, and they're almost educating everyone. They're almost cooperating. They're putting out press releases. They're not really talking smack about one another. They're sort of trying to validate that a space exists. Later on, as a market segment it matures, you begin to find those 3, 4, 5 competitors beginning to get funded. A lot of the VCs act as herds, unfortunately. A lot of the entrepreneurs act as herds, unfortunately. And a lot of the selling that you do is no longer as educating and public education, but rather you begin to say, well, this is why we're great, and then you say a landmine why everyone else isn't as great. And usually at some moment in time after that, a number of the large companies who sit in those industries will start putting out press releases about these big initiatives that they're launching that are going to conquer this new idea that's been put out there in the startup press. And without too many exceptions, they fail. And that's when they start buying things. And so I usually look for those sort of 3 or 4 phases along the way to sort of engage. And as soon as I see a big company announce an initiative, I know that's my magic moment to really nudge the entrepreneurs to reach out and just sort of make sure everyone knows that they're there.
Yeah, those are great inflection points. Yeah, perfect. Yeah, the other thing is, one piece of advice. As one client is brilliant. Semiconductor space. He was an M&A expert. He's in the semi space. He knew everybody that was buying and selling into space and what valuations. And he also knew the fundraising as well. He knew the corporate finance landscape, and I think a lot of people do not look at that. And it's very important actually to figure out what's going on. Just that perspective. This guy came to me and he goes, I had one transaction that was very similar to his company, selling for 14 times revenue. And I said, that's, it's high because the average is 5x revenue. So you're probably going to sell for 5x revenue, but I'll put any number on the table you want. And the guy said, I want 14x. We put 14x on the table. The other side accepted it because they needed him desperately. It was not a question of math, it was a question of need. They just wanted one number, they go to the board, their board, multi-billion-dollar public company saying, hey, there's one transaction, 14x, done. So look at the corporate finance environment on a regular basis. Take 10 minutes a day, it's worth it.
We was a strategic acquisition, so so a lot of, we do professional services, so professional services companies are valuated by EBITDA, so probably 7 to 8 times.
Yeah, all right, yeah.
So we were evaluated in a different way. I can't disclose what it is, but it was based on the revenue. So the revenue is a different, for a company like us, is a different way of evaluating. And it's because they wanted to get into that space. So we predict, personally I predict that now that will start like a landfall of different companies like us. They were the first to do that. And in the space, like the professional services space is definitely, especially in the cloud space particularly, is you get a lot of, one of the reasons why we sold, one of them is I don't want to be the richest guy in the cemetery. That's what Steve Jobs said. So I want to do other things, not just one thing. So, yes, I could have grown it to be a lot bigger company, but I want to do other things, and it's just the right time. The other side of it is understanding the market. So the market, what we were faced with is a lot of competition from both the cloud vendors, the big Amazon, Microsoft, they're all in the space. VMware, it's getting very crowded. And what we do, they're doing this service sometimes for free. So we're kind of okay. Our margins, we charge like $250 an hour if anybody wants to employ us, but our rates will go lower and lower. So it's like a tension on the market. So what do? We have engineers, we have to train them up. It takes a long time. They leave. We're the people business, right? So the product is different. People they can leave at will. So it's kind of there's writing on the wall. I think there's another 2 years of what we do, but it's kind of understanding where the market is and doing it at the right time.
No, I just make one comment that we sold a similar company. It's basically a cloud services company doing the integration work for Microsoft.
There you go.
And the question is, how long is your company going to be unique? So everybody needs cloud right now, but you look back at the .com boom, everybody's building websites. How long did that last?
Yeah.
A few years, right? But to your point, John, it's probably going to be 2 or 3 years where everybody's got their cloud already. All right, I've already got the cloud.
IoT is the next big thing.
There you go.
Cloud is like...
Cloud's out, IoT's in.
Other things.
Heard it here.
So we're now gonna open up the panel to questions, and then we'll save a few minutes at the end of the question period for each person to sum up their most important pearl of wisdom to impart. So anybody have any questions?
Minimum viable product. I mean, do you go out to Angel or do you do it primarily with your family and friends? That first step for minimum viable product, how means most likely in your experience, what you see happening in the market?
To start off with, I'm all about agile. So agile, get your Scrum board out, get your stories, do some market testing, market research, find out if there's buyers in that market. And sometimes though, customers don't know what they want, right? So the minimum viable product is getting a customer who, we think that you need this, will you take a chance on a minimum viable product? It's going to be ugly. It's going to be, the first phase is going to be 3 weeks, and it's going to be warts and all. It's going to be using, it's not going to look good. And let them play with it. And the key is with the minimum viable product is the feedback loop. So enable whatever if it's software, enable that feedback loop so you can get some good feedback, and then adapt your storyboard into that. But only when the customer sees that will you really know what and feels it will give you that real valuable feedback, in my opinion. But I don't know.
You're probably the one.
The question was, how do you fund the
Yeah, how do
MVP? I mean, in effect,
Totally shit.
no, it's okay. No, I think the 3 Fs, the friends, family, and fools is one way. To a certain extent, I've done this before where you pre-sell the concept to someone. You say, this is a tough one, but you say, what if I told you that I had the following? Would you be willing to pay for it? And if you get a couple people who say yes, and you can begin to spec it out. So again, that research, being a detective is as important as anything. And the really crafty people are able to get their customers to fund a pilot or an alpha. It's been done before. Sometimes you can even do it as a consulting project where you retain the IP yourself if you have a good lawyer. So there's some guerrilla entrepreneur ways to get it done.
What are your thoughts on raising from strategics and perhaps pulling strategics together to invest in your company? And do you potentially pair that with a financial institution to potentially bring discipline into the round or help kind of lead the round? And kind of what are your pros and cons or perhaps past experiences on that?
Strategics always sound great. You're like, they know my business, they're a customer, it all sounds really good. One of our portfolio companies had 3 strategics come together. Okay? Day one, it was an amazing opportunity. It was great. That's day one. And every day after that, the strategics started to, they're competing. Different things here, going different paths, new management team. And then when it came down to 3 or 4 years later, when they went to sell the company, it was a really difficult board meeting for them.
So you found like that's that democracy there?
Yeah, it was. It just said it became, they all had their own agenda around the table. So I'm not a big, we've actually, one of our companies just turned down a strategic investment. We'd rather have them as a customer.
Did you find that strategic investments help tie deeper operating level relationships potentially, or do you find, for example, you turn them down, you can still have a sustainable customer relationship?
Completely sustainable customer relationship. It depends who's doing the investment. If it's Comcast and they have a venture arm, then they might just sit there and go, well, listen, we like the business, we like the space, we can introduce you, but this is purely an investment. It could be another company that going in and saying, you're strategic for us, and we were not, but now they've got a reason they've invested in you strategically, and they're going to want to see that roadmap, and so there could be a thing. So from our experience, it's never been,
It can actually complicate the sale too. So say Google Ventures invests in your company, they've got a minority interest, this is great, we're selling to Google. Then 2 years later, you try to sell the company, and Google, will probably have a first right of refusal, which is not the death sentence, but the other competitors to Google will look at it a little bit differently. Let me put it that way. They'll be a little less excited because Google's already in it. And then you have one buyer. You get a locked-in buyer, and if you sell to one buyer, your price goes down.
You guys have mentioned that VC companies in general are picking up the bar of a minimum investment. How do you feel about these new platforms coming out for equity crowdfunding in return for either direct equity or convertible notes?
I can do it.
go for it.
I guess this is videotape, so I'll say what I actually think anyway. But no, I guess I'm a firm believer in so-called smart money, and I'm not saying that I'm smart or anyone else is smart, but you choose someone who you think is smart. I think so. One element of it is just keeping people inside your company's sort of aura that add specific strategic value, and I guess I worry a little bit about just taking pure money. The one scenario where I do see it as valuable is if you're pre-testing a consumer-based product and you're essentially pre-selling something to people. So I think there's it's still being evolved right now. Like we don't quite know exactly what the optimal match is for crowdfunding and startups. My gut reaction is that if you're selling some product that consumers might want to buy, and you have a way to reach them through a crowdfunding site, and they can prepay for them, and you could use that to fund your development without giving up much equity, if any, that's great. But there are a lot of other scenarios where I think you may get yourself in trouble. I also think from a regulatory perspective, it's a little bit of a landmine in my personal view. While it's legal right now, and the pendulum has swung in the direction of empowering people to invest in companies, I think a lot of people don't totally understand that it could be 7 to 11 years they have to hold on to the company for. And at some point, some lawyer is going to figure out how to sue you for it. So I just worry about having that potential liability in the future. I'm not a lawyer myself. I'm just, if I was coaching an entrepreneur, I'd say, I bet you can find some people who have expertise in the industry you want to penetrate. I bet you can find some great smart money who can coach you at skill sets you don't have. And I think you might want to consider focusing on that.
It's scary.
Yeah, I would agree with that. I think, it's a great source for a lot of companies, but, I'm waiting for the first scandal to hit, and it's actually one guy that, fraud. This guy just raised, I think, $30 million on a crowdfunding site, and he hasn't built a product yet. So it's a bit problematic. He's a little behind his product life cycle, let's put it that way. So here's what happened to $30 million.
But he's in need of this right now.
There certainly will be frauds, or on this side of fraud that's not quite worth pursuing, but we all know it.
Yeah, okay. Alex, I want to just agree with you. I think equity crowdfunding is actually silly, because if you can sell swag or pre-sale, as you said, that's probably the smarter thing to do and raise money rather than give away equity. So crowdfunding is great. Giving away shares is dumb unless you can get a lot of money for it. So I think I agree with your point. Thank you.
Other questions?
Sure. Can you expand a little bit on where you see valuations going and what's changing in that space and where multiples are going?
It depends where you live. If you live in Silicon Valley, they're through the roof. It's
Here,
interesting.
We're in New York.
Yeah, it's driven, early in the angel seed stage, it's driven by one thing, and that's demand. If you've got one person at the table, I can't value a company on revenue, I can't value a company on anything else. If there's one person, you're trying to raise money, and there's only one person at the table willing to offer you money, that's what it comes down to. If there's 7 or 8 people, now the entrepreneur's got a little bit more power. But at that early stage, it's what smells right. I was saying earlier to somebody, it was like, we had a company to come to us, it was 4 or 5 months old, and they said we wanted pre-money of $4 million, and it was 4 months old, and you think it's already got $4 million of value. This just didn't smell right. But they went out and found $750,000 of people who thought that there was value there. So
Yeah, I think on the M&A front, there's, you can do your valuation analysis, right? So you do comparable companies, which are public companies, look at their multiples, see how they trade. Is it revenue? Is it EBITDA? Typically, it's revenue for most tech companies. Then you look at precedent transactions. IBM bought this private company, Google bought this private company. What are the multiples there? Take the average, blend the average, and that's your valuation. So it's interesting. I mean, we just had a call from a CEO in Silicon Valley. So I was mentioning Silicon Valley, and they're all drinking the Kool-Aid out there. And he was like, "We're at 12x revenue." It's like, okay, great. Hear him out. He found the company. He's excited. That's good. We talked to the CFO, because we've got a buyer for him. It's, the revenue multiples 4 to 5x. I said, would the board take 4 to 5x? He goes, yes, they would. So the board is the decision maker, not the CEO. And he should be excited. He's trying to get us pumped up and get more value. So I think you'll see that trend a little bit, yeah.
I'm just curious, when you, when you meet the management team of a startup, do you like to see that there is at least, there is actually more than one founder? Because I've heard some VCs say that they like to see at least 2 founders, not just one. And do you think there is some truth to that? That maybe having 2 is better than just having 1?
I think it's sometimes, I do think, being a founder, you probably guess it's better. It can be a lonely role.
Look at Elvis Presley, look at the Beatles. The Beatles is classic.
I can't follow that. I would prefer there to be two founders, as long as they've got skills to complement each other. It really depends on the skill and what they're trying to accomplish and what the product, the marketplace is.
I think, so first, it's funny because Ed Roberts is at the Sloan School, and he has done some academic research, I believe, that has predictions around, if you have a higher quantity of founders, you have a higher prediction of success, I believe, according to some of what I saw a presentation of him a number of years ago, I believe that's what it said. At the same time, I do think that having a governance structure in your company's management team and in the board, where there's a clear leader who is responsible, it's the single throat to choke, is kind of an important thing from at least my perspective, and I think Jeff's perspective as well. So I think there are benefits to having multiple founders, and the, for lack of a better word, social networks they have that may be different, and the reach they have to find additional customers, employees, etc. But having sort of a force of nature at the helm, I've found is the biggest determinant of success as well.
And that evolves. We invested a company 2.5 years ago. There's four founders. They're now down to 3. But in our term sheet, we took responsibility of compensation away from the CEO, co-founder, and put it on the board. Because we knew when we were looking at him that this person, the CEO, is really the person who should make the decision of the company. CTO is awesome. Chief Revenue Officer is great, but we didn't want him to be in a situation where he felt like we all have to be equal. And we're 3 years later, and he's got a different salary, different equity base, and they're all fine. Like, they get it that this is the guy who's run the company. So
I always recommend, like, if you've got 2 founders, never do 50-50.
Never.
Ever. Like, ever.
Right.
Because I've done it before. It's my first rodeo. I live in Texas, so I can say that.
And so, coming off Texas Rodeo.
Yeah, I've actually got a picture of me with a hat on.
All right, we'll talk about that.
Listen, all I bought was a washing machine and a hat after the transaction. All I've been doing is work. It's like, so never do 50-50. Like I had 4 founders and I had 25, but I was still the CEO, and it was just arguments every week. So make sure there's one person that's the majority, and hopefully make them the CEO or whoever the decision maker is. Because if you haven't got that, you have to have a board, or you have to have somebody else making decisions for you. You can never get the business running.
Right.
It's just you're just arguing with yourselves to succeed. It's not good.
If you can't get to $500,000 with friends and family, like I'm thinking about, people in the Bronx who don't have the necessary network to get to that point, how does the venture capital community sort of tap into that network and support those types of entrepreneurs that presumably could be supporting communities of need?
There's a lot in the city of New York, incubators and accelerators. And these are great programs that you apply, you get in for 3-4 months, you get $25,000, you get office space, you get free legal counsel, you get a mentor program, and they set you up for a demo day. And demo day is, it's a show. They'll fill a room with 500 angels and VCs, and you've got 4 minutes on a stage, a captive audience, and expose it. So there are ways of doing that. At the same time, the cost of building a business has dropped significantly. So, 10 years ago, before the cloud, it was very, very expensive. You had to raise a lot of money, and I don't know the stats. I'm sure Alex probably know them. But the cost to raise a business, to start a business, software. You don't have to license it anymore. You have to buy it.
Yep.
Storage. Amazon and Google all offer
1 cent.
1 cent to store in the cloud. So much that can be done. So what you're really paying for to start a business early stage is maybe people to help you. But if you have that skill that you can program and you can tap into, hey, my friend's an accountant, he'll help me with the modeling. There's scrappy ways to do it now that weren't as available 5-10 years ago.
Yeah. It never buy servers. Yeah. Basically, use the cloud.
But incubators and accelerators are great. There's got to be 12 to 18 of them in the city.
And Jeff and I both volunteer all the time for them. Like, we
Right.
literally just have people bounce ideas off us all the time. And it's fun. There's a great energy from people who have entrepreneurial ways of thinking. So I love it.
Right.
And they will take money with just an idea, deal with people who have just an idea. So, other questions?
So just a little bit further on the conversation around incubators. I mean, what are they really providing you? Like, let's say you're a non-technical individual with a great business concept, but you can't code, right? You can't build devices, but you're looking to put all of this together. I mean, they'll provide some level of capital.
Yeah, they provide, every incubator site has got a little different spin on it, so, but, they'll provide office, limited capital, legal, tremendous large mentoring programs. So, you'll see the mentoring will be across every sector. So they're going to interview you and go through and say, do we have mentors that can support this woman or this gentleman in a program? I might also say to you, listen, I like your idea. I actually want to match you up with somebody who's technically capable. There's a lot of Tinder for founders out there.
One of you gentlemen mentioned that you thought that the range of current seed rounds was perhaps between $500,000 and $1.5 million, I think you said. What's the range of the percentage of the company that the founders are giving away on deals like that?
About 25%, give or take. Again, everything's negotiable. It goes back to demand. It really, but as an investor, I want to see my entrepreneurs have north of 10% going into the A or B round. Like, they have to have skin in the game. That's the company. If they don't, then they're a flight risk, and then I'm screwed.
Have time for one more?
How do you feel about founders paying themselves? What salary range is acceptable to you?
Did we just have like 80 emails?
Yeah, I think we did have 80 emails. I think it says, someone comes to me at an early stage, says, this, I'm raising $500,000, and that's, 200 of it's for my salary. I'm like, go back to corporate world. It's there. The four co-founders in one of the companies, now down to 3. Their salary was $40,000.
In New York?
In Boston. No, but
That's the question.
it is expensive, and I will tell you, I think it's. I take my hat off, and Alex said when we meet with these entrepreneurs, take my hat off to them. Done that, lived it. God bless them. It's a roller coaster ride. It's not clear.
There's a scrappy period of time during which they're having less monetary compensation than they otherwise could elsewhere. I'd encourage everyone who's in such a situation to put a very clear time limit on things.
Right.
Make sure your family and loved ones, you all have sort of an agreement of what's the milestone that you're going to reach or you're not going to reach, and go back to, you don't want to risk your mortgage on such a thing. So it is true what was said earlier. I mean, it's different people are in different financial situations. Different people can sort of take these experiments for periods of time. But you find these people who, kudos to them, and I've been that before. You're taking these sub-optimal cash salaries, and the goal is the dream. So your equity is going to be, way more than you would otherwise have.
I've got some advice actually in New York, so I'm not from this country. So to save money, don't have an apartment in New York, have an office. Buy a gym license, gym pass.
That's your shower?
That's your shower. Honestly, you've got a room. You've got like a doorman, a nice place. It's probably $1,000 versus $2. And you go downstairs before the clean lady comes in, and you have your shower, and you back, and then the police arrive.
And happy hour.
Happy hour.
The happy hour is usually free food.
Exactly.
We're the best happy hours, John.
Oh my gosh,
I tell you. But that's the best. And the most important thing is always pay your employees. Always. Like if you miss one payroll run, you're done.
You're done.
Right. So and also before you get the valuation, what will happen is if you don't pay yourself something, you'll overinflate your valuation. especially on EBITDA, because you're not paying yourself something. So definitely suggest like putting your salary market rate, because otherwise this is going to look at you.
Right, you're going to normalize
It's
your
$30,000.
I'm a profitable business, but I'm having to get a salary.
Right,
You're not
right,
profitable.
right, exactly. So,
Here's the opposite example, and this is another sign of a bubble, at least in Silicon Valley, is that there's this company called Whisper. It's an app.
Oh, yeah.
And it's an anonymous app, right? You seen that?
Yeah.
And I was, playing with apps. It's kind of interesting, right? It's like, Meerkat right now is cool. It's like, yeah, you look at different apps. It's just fun. So I looked at Whisper. Look, it's kind of interesting. My boss sucks, whatever. It's like an all anonymous. These guys took off the table $1 million each, the co-founders, just because they wanted $1 million as part of the deal. There's so much competition for this company. They got $1 million each, pocketed it for their equity, and the app shut down 3 months later. So that was pretty, they get it, great, but it's
So
fab.
our advice to you is ask the VCs for $1 million each.
No, it's not true at all. Exactly.
At this level, it's a big range, 40,000 to
They're 40, and then a year, listen, they're now 24 years old, their salary, one of them's salaries is now 75,000, but they have 12% of the company, it's going out, valuation of the company right now is, which means nothing, it's paper, is north of 14 million. So they're on the right path, but they see they're on the right path. It's different if you're trying to start a company and you're 35 and you got 3 kids. That's a discussion between your wife or your partner.
Part of the answer to that is to know just how much all of your compensation should come from your equity. So what you need is what you absolutely need so that they're not throwing you out of your house, because we don't need CEOs worried about literally being thrown out. But if you've got a window, the funders need to know that. Because funders can deal with that. We can, funders can know that, well, you can survive on this tiny bit for a year or 2 or 6 months, and take that into consideration when funding the company. And if there's not a deal to be had, there's not a deal to be had. So why don't we start from the company perspective?
Well,
and give
words
us
of wisdom.
What pearls of wisdom can you give these aspiring entrepreneurs?
I don't know, just try something different, be passionate about what you do. Don't, and never give up. So.
Passionate and understand it is a roller coaster ride, not week to week, month to month, hour to hour. You'll go from the highest highs to the lowest lows like that. So the passion has to get you through those highs and lows.
I think, again, particularly for technical co-founders and founders, I just highly encourage you 3 words: ask the customer. There's nothing more important. Every day you should be just trying to understand exactly who's buying why, and just be able to parrot it back to your team. Make sure everyone who's building your product, marketing, selling, you name it, they all know exactly the words that your customer or potential customer said.
Yeah, I think from the M&A perspective, when you're selling your company, people always focus in on the valuation, the terms and conditions, and to the penny, right? The reality is that it's very rare to sell a company. Actually, as a founder, it's a rare occurrence. Most fail, right? That's the reality. Some IPO, but very few actually sell. So, although it's very important, the valuation, look at the kind of your life history, if you will. So if you sold a company and you've got a 2-year earnout, people are going to be chasing you in 2 years, right? Because you sold your company successfully, you've done it.
Yeah,
and then you can sell your next
Facebook
one.
as well.
Sorry?
There's another little hint. Never put anything on Facebook.
Never put anything on Facebook. There we go.
You get like a lot of people like, oh, I remember when I used to like play with you at school. I'm like, I can't remember you. I don't know.
Oh my God.
There we go, exactly.
So don't put it on Facebook.
Yeah, right. Exactly.
Okay, well, thank you all for coming. We'll be around for a couple more minutes. Thank you for your time. And, if there are any questions, feel free to come up. And thanks for coming.